Picture this. You walk into a Canadian bank with $1,000 in your account, and you're treated like one kind of person. You walk in with $1 million, and you're treated like someone else entirely. That split, cold, clear, and intentional, is what I'm unpacking today. I'll show you exactly how Canada's Big Five treat you at each wealth level, why it happens, and what you can do right now to make the system work for you. Start at the bottom. You have a checking account, maybe a savings account, and some credit card debt. To the bank, you're not a client, you're a product. You pay up to $30 a month just to keep your money there. Your savings account pays 0.1% interest, while the bank lends your cash at 5 to 20%. Your credit card charges around 19.99% interest. Every branch visit is a lineup. You speak to junior staff with sales targets. Nobody from the bank calls you. The bank's goal here is simple: collect fees from you while giving as little as possible in return. Move up to the middle class. Between $50,000 and $250,000 in assets, you have a mortgage and some investments. Things look better on the surface. You get a personal banker who knows your name. Monthly fees might be waived if you keep a minimum balance. Your card has better rewards. You get faster branch service. But the core issue remains. The bank still makes far more from you than for you. Your personal banker has sales targets. Every product they recommend puts money in the bank's pocket. Investment management fees of about 2% are common. On $100,000, that's $2,000 going straight to the bank every year, regardless of market performance. Now it gets interesting. Hit around $500,000 in investable assets, and you step into private banking. The rules change. You get a dedicated private banker with a personal cell number. You skip lineups. You access investment products the public can't buy. Fees are negotiable. Tax planning consultations become part of the package. The bank calls you, not the other way around. Preferred mortgage rates, faster loan approvals, better terms. The same bank that charged you $30 a month when you had little now rolls out the red carpet because you have money. Above $5 million, you enter ultra-high net worth territory. You receive a full wealth management team, access to private equity and hedge funds unavailable to most, family trusts set up by in-house legal teams, estate planning handled for you. Fees drop to the lowest levels or disappear. The bank that nickels and dimes average Canadians is literally competing for your business. That contrast? Not an accident. It's designed that way. Here's the ugly truth. Canadian banking operates on two sets of rules. One for people with money and one for people without. The Big Five made tens of billions in profit last year, and a large chunk came from fees and interest paid by everyday Canadians who could least afford it. The less money you have, the more the bank charges. The more money you have, the better the deal. That's not a bug, it's the product. So what can you do about it right now? Practical steps you can take this week. Step 1. Stop paying monthly banking fees. Move to a free Canadian digital bank like EQ Bank, Simply, or Tangerine. All legitimate, all free. Your account should work for you, not against you. Step 2. Move your savings into a high-interest account, paying around 4% or more. EQ Bank and similar challengers often beat the big banks by a large margin. On $10,000, that gap is hundreds of dollars a year. Step 3. Stop buying bank mutual funds. Open a low-cost robo or discount account, Wealthsimple, Questrade, whatever you prefer, and invest in broad, low-fee ETFs like XEQT or VKey. Management fees drop from around 2.5% to 0.2% or lower. On $100,000, that's thousands saved every year. Step 4. Pay off credit card debt immediately. That 19.99% interest is the best guaranteed return you can get. Eliminating that debt is like earning 20% on your money. Step 5. Max out your TFSA every year. Contribution Room is tax-free growth for life. Keep the money in low-cost index funds, not expensive bank products that eat your returns. Here's the part banks don't want you to think about. You do not need private banking to build wealth in Canada. With a free bank account, a TFSA, an RRSP, and low-cost ETFs, you can capture the same long-term returns private clients get without the markup. The tools are available to every Canadian. The difference is knowing how to use them. If you want to calculate your exact finances, try mycalchub.ca. No sign-up, no cost, built for Canadians. Links in the description. Subscribe to Money Mastery for weekly breakdowns the banks don't want you to see. Build wealth. Live free.